good morning, students. Today I'm going to talk about the derivative segment. In the previous session, we had discussed about the future and the forward contracts, and in this current part, we will discuss about the options. So, verbally, just let me discuss in a nutshell what is the meaning of option. So, options are not an obligation like forward contracts and the future contracts, where investors are supposed to bear huge losses if they can. Have an access to earn huge profits. So similarly, they tend to bear a lot of losses, huge losses, so far as the forward trading or the future trading is concerned. Unlike options, options are basically two types: the call option and the put options. And in the call option, if the prices are moving upward, like the similarity is same. This is also available in the contract size. This is a contract size, lot size, but instead buying the whole lot, they are supposed to pay a premium. So through one of the example, we will try to understand firstly the call option. Okay, for an example, we have one company known as ITC. ITC is a company. Okay, is a company whose call option is available at 300. Okay, rupees 300, right? ITC is a company whose call option in the form of lot, which is available at 300 at the rate of the premium, at the rate of the premium, as I said, because the investors are only supposed to lose the part of premium, even though they buy a huge lot. Maybe they bought 100 shares of the 100 call options of ITC, but they will lose only a part of the premium. So there is a limited losses but unlimited profits. So through one of the examples, we will try to understand that how does it basically work. So the premium amount is, for an example, I say rupees, say, mm, 30. Okay. So what we are expecting to to calculate the total net payoff by the investor. Okay, by the investors. So we will try to calculate the total net payoff by the investors. Again, try to understand the call option is available at 300 at the rate of the 30, which is payable as in the form of the premium. So we will take a look here. We have already, this defined the table. Yeah. So 1, 2, 3, 4. I have created 4 columns here: the prices on maturity, exercise lapse, gross change, and the net payoff. We have understood here the what is the price? 300. Premium is 30. So again, see here. Firstly, we have to calculate the break-even point. Investors will only have the net profit if the prices will cross beyond of that the break-even point. So break-even point, what will be the break-even point here? Break-even point will be here 300. Okay, the call option price, and calculated as the premium, which comes here. How much? That will be 360 rupees. Okay, so that is what known as the break even point. So break even, whenever this will cross 360, then only there will be the net profit for the investors. They will enjoy the net profit. And how does it function? We will take now through one of the tables which we have created. So prices on the maturity, for an example, if I say there is a price on maturity is 280. So what will happen here? Will the investor exercise the call option or will it let it lapsed? Okay, because I have said when the prices are moving upward, then only investors will have profit. Otherwise, no need to exercise this price on maturity 280 because it is less than the 300. Because 300 was the basic price. 300 was a basic price, and if we calculate we the merge it with the premium amount, this will go the 360 rupees. So he will let it go, he will not exercise. So he will, what he will do, he will lapse the price. Okay, he will lapse the contract, and there what will be the gross change? There will be a gross change that 30. Net payoff will be, and he will have to pay only 30 rupees. Okay, 30 rupees as a part of the premium. Only the premium will be lapsed. Okay, what I am trying to say, only the premium amount will be lapsed. Now for an example, this will go 290. Then what will happen? Again he will lapse the contract. He will, it is not, since it is not an obligation, so he will lapse the contract. So what will be the gross change? Again, he will lose the premium amount. How much the premium amount? What will be the net effect? The net effect will be again rupees 30. Okay. Now, if it goes 300, what will happen? Will he exercise the contract or he will lapse? Again, he will lapse because it is a 300. So what he is about to lose? Only 30 rupees. Okay. You will see and you will get surprised and you will understand that how this type of the trading is working nowadays. So again 320. So what will happen? He will exercise or he will lapse, because if you compare it with the break even point is what? Break even point is rupees 360, but he will not lapse because reason behind you will understand here. Exercise, he will exercise because he will lose, definitely he will lose, but the lose amount will be lesser than the premium amount. Okay, see how 30 rupees he have to pay the premium. Okay, since it has crossed 300 rupees by 20, so he will lose. What will be the his net payoff? 30 rupees he has to pay as a part of the premium, but here 20 rupees he is earning also. So what will be the net payoff? Net payoff will be only rupees 10. The total lose amount will be rupees 10. If it is for say 350 rupees. Okay. So what is going to take place? Just take a look here. Sorry, here this is amount is 30, not 60. We have to rectify this. 320, 330, right? Okay, 350. So will he exercise or will he lose this? He will exercise the contract. And how much? The losing, the premium will be same, the gross change will remain same, because every moment, whether there are the profit, there are the losses, he has to pay one fixed amount which is known as the premium, right? So he has to bear this much of amount, rupees 30, at any cost, whether he let it lapse the contract or whether he exercises the call option contract. So what will happen here? 30 rupees. So will it be profit? Here he will start generating the profit. Net payoff will be 20. But why 20? Because here he is break even point is how much? 330. 330 break even point, and 350 is increasing. So what will be his net payoff? His net payoff will be rupees 20 here. Okay. So okay, so let us take a look. For an example, if it reaches 400, then what will happen? Will he exercise or will he lapse the contract? He will exercise the contract. 30 rupees is fixed in the form of the premium. So what is he is going to have at the end of the contract? So what is he going to have? This way he is going to have 330. 30 is 330 is the break-even point, right? And 30 is going to pay as a part of premium, so that will be 70. So 70 rupees will be his net payoff. Okay, so if you will see here, and starting point 280, he will get it lapsed. See, now with the traditional way, take a look. What was the break even point? What was the break even point? The break even point was how much? The break even point was 300 plus 30, yani 330 rupees. 280, so he will get it lapsed because he will not exercise, otherwise there will be huge losses. So there is a policy from the stock exchanges that they must design such type of contracts where investors are not bound to lose much of the value. Okay, so they have limited their losses by only bearing the loss of the premium amount. So here if you will take a look, so there they will lose only the premium amount. And also in the case of the profit, 350. Okay, so if it reaches, for example, 350, so 350 and minus 330, because that is a break even point. And if they exercise this, so they are going to have this much of the profit, 20, which I have mentioned here. Okay, for an example, now see, if there is a lot size of the 400, so what will be the total net payoff? What will be the total net payoff if there is a lot size of 400? Okay, just take a look here, 400 and then multiplied by 20, because it's per share I have calculated here. So at the end of the contract, they are going to have this much of the profit, 8,000 profit. Okay, and very less uh, premium. So they have limited their losses and they can earn unlimited uh, profits from these type of the contracts, which is known as, here I have mentioned, the call option contract. If we make a graph on that, okay, in the later part I will also discuss in depth that how does it basically the graph is done here. So if I calculate right here, so we will see in the depth, I will discuss in the later part of the session, in the next session. See, mm, it is calculated like this. Okay, what is the break even point? Break even point was here somewhere, this. How much? The break even point was 330. Okay, below 300 point, they will bear they will lose the premium amount. So what is the premium amount? Premium amount is this fixed. Okay, premium amount is this much of fixed, and what they are going to earn here, this earning point gets started. What is this shaded region? What is this shaded region meant for? I have mentioned here, which is this much of amount. Okay, the premium amount, because that is fixed. Only whether they earn profits, whether they earn loss, this much of amount is fixed. That is known as the premium amount. So in the call option, whether it is a call option, whether there is a put option, investors are bound to lose only this much of the premium. Okay, and unlimited profits up. This is a 300. Here it comes for an example, 350. So 350, this much of the profit they are going to have. This is a profit region. Okay, this is the profit region. This graph about the call option and the put option we will discuss in depth in second part of the session. So after that we will soon discuss about the put option, so far as this derivative part of derivative segment is concerned. So We have just mentioned here the points related with the call option. So in the call option, again, if you see, if ITC is a company whose call option is available at 300 at the premium of rupees 30, calculate the total net payoff by the investors, and through the table we have now understood.